we might as well talk about the 50-year mortgage.
$1 million home, you're going to spend like $5 million total, like $4 million in interest.
Multifamily has gotten so good at squeezing every drop of income out of that asset class.
Our consumers in brand new house
That's
Yes.
a great
for the
point.
same price, right?
So as we put in new homes, they're buying into a community that truly is a community.
We can solve affordable housing if you let us build more manufactured housing communities. Welcome back to another Cash Flow Quest. We got another panel, weekly panel. We're fired up. We're going to cover some fun topics in that there's so much going on that I don't know where to start. But we're all fired up around here. The whole office is humming. But in the realm of real estate and interest rates, there's some headliners that we can't pass up this week. So we're going to kick it off with an open discussion because it's pretty confusing. And I'd say some of us know deeper levels. And then we have some common sense elements to the Trump news of buying $200 billion worth of mortgage-backed securities.
Mm-hmm.
And so I'd like Ben to lay the framework, and then I want to pepper him with questions, and we can hopefully unearth what this really means. We know that interest rates have come down at least a quarter to maybe a half a percentage point. Home loans now are being originated in the 5.9% realm. So what the heck's going on?
Yeah, so mortgage rates right now are below 6, which is great. I mean, they were like 7, 12 months ago. So the fact that they're now getting below 6, I think that's an awesome rate. But the news, I mean, they obviously were getting bid down after the news that Trump announced that the Treasury was going to buy $200 billion worth of mortgages, right? So just mortgage-backed securities. And that's just another form of quantitative easing. So when people talk about printing money or quantitative easing, it's effectively just the Fed monetary, really the Treasury buying more bonds, right? Fixed income securities. For this discussion, he's talking about buying MBS, mortgage-backed securities, which essentially puts the loans onto the Treasury's balance sheet and injects liquidity into the market. So anytime you are buying a bond, you essentially are putting the price of that bond higher, and the interest rate has an inverse correlation to price. So the more demand or buying that happens on fixed income securities, the lower the interest rate becomes of that. So that's really the what's happening here is that
is a mortgage-backed security that is backed by the government, is that technically a bond?
Correct.
Okay. So anything backed by the government in the mortgage realm is technically called a bond. Because I think that's a clarifying point.
Yeah, in just fixed income, right? Just fixed income securities. When there's a loan obligation that's backed by some form of collateral that pays an interest rate that's fixed, or it could be variable, right? Okay. It could be an adjustable rate mortgage, right? That has some sort of interest rate that gets paid for holding that liability, right? But if you hold the bond, it's actually an asset. It's a liability to the person that takes that loan, and then they hold
balance sheet of the Treasury.
Correct, and it has a maturity
$200 billion
date.
Would have mortgages now that are to be paid back, and they're collecting the interest on those mortgages.
Correct.
Okay, so let's go one layer further because I think this is an interesting point that it took me a long time to learn this. So if you own a home currently, or you are interested in buying a home, when you go through the home buying process and you get a loan that's originated on the behalf, and that's the whole running around of getting pre-qualified and getting approved for a home loan at a certain amount of dollars, is that you have a good credit rating or a credit rating, and then you have enough income to pay back a set amount of dollars that is given to you on the loan, which then dictates how much purchase price you have and you can go buy a home. Well, every single loan that's originated, I'd say 99.9%, are then packaged into loan pools. It's like a big grouping batch, and basically it's on a spreadsheet of hundreds different names of the trust and the people that are buying it. In the case, if you're buying a home, your name hits there. It's the loan amount, the payment structure, the interest rate, and it's this huge list. Those lists after maybe a month, maybe what's a tranche? A tranche is a grouping of a month or two. How long does it take to batch?
Oh, that's a good question.
Maybe a quarter?
Yeah.
Maybe 2-3 months?
I have no idea on
I'm just
how
going to say
long.
monthly or quarterly.
It's going to happen pretty quickly though.
Yeah.
Quarterly.
Depending on how big the operation is.
Yes.
So then you take all these loans and those go out in Wall Street for bid. and the highest bidder buys those loans, and those are fixed rate. What'd you call them? Fixed rate assets.
Yeah,
Fixed income.
Fixed income.
Yeah,
assets that those buyers buy, and it's sovereign wealth funds, it's
pension funds,
it's country. In this case, Trump is buying a couple $100 billion worth of these products. So I'm just trying to make it like really clear of what the heck this is.
Yes.
And then what that does is he's basically come in and increased demand, and how much supply now is less, and there's more demand.
Right.
And so with that demand,
competition,
the interest rate that people are charging goes down.
Correct. Yeah. The interest rate for, call it like new securities, goes down because the price of those bonds goes up. And if you just think about it's a perfect example, right? Like, so if you, it's no different. It's just supply and demand. It's no different than anything. If there's a certain, let's just say, car that everyone wants, right? And the MSRP is
a GT3
Porsche,
a Panda Rolex.
It's Panda Rolex. The MSRP is $100,000. Well, the more people that want to buy it, it's going to sell for more than $100,000. Even when you go to the dealership, they're going to mark it up because the other person's willing to pay $120. Right. So then this person will pay $130. So they're going to sell for $130. So it's like the same concept. It's just there's an interest rate attached to fixed income, which confuses people because it's an inverse relationship. Price goes up, yields go down. Bonds sell off, yields go up, because you have to have a higher yield, meaning a higher interest rate, to incentivize somebody to hold that bond. That's why risk and reward, as you go out in duration, or if you go out and the longer you hold a loan, right? So you have 1 year, you have a 6-month loan, 3-month loan, 1 year, 3 year, 5 year, 7 year, 10 year, 30 year, talking about a 50 year, right? The longer you go up, the interest rate should be higher because you're taking duration risk. You're holding that bond for longer, and interest rates can move up or down. So if I hold a bond, right, say I'm holding a 10-year bond, and the inflation starts to spike, right? And the going rate for new 10-year bonds is much higher. The interest rate's much higher. Well, the price of my bond, right? It's going to pay that same interest rate, but the price of my bond is going to go down because the go market rate for that bond is much higher now. So now my bond, if I were to go sell it on the open market, is going to be worth less because the interest rate is locked in less. And so the longer you take term out or duration, theoretically the higher the yield should be because you're taking what's called duration risk. Now,
yeah, cool. You got to beat inflation and the rogue element of what happens.
Okay, I have a question, just for clarity on my sake. So if somebody buys a bond that's paying a 5%, right, cash on cash, that all these mortgages are tied to that are paying that 5%, and then you're saying the more people who buy these, right, it's worth less, and interest rates will go up. Or if interest rates go up over here, then your 5% bond that you've purchased over here is worth less. Is that correct?
If I'm holding a bond that's paying 5%, fixed, right?
Yes.
And interest rates go up.
Yes.
The price of that bond goes down.
Because if somebody came in to buy a new bond today and interest rates over here were at 7, hypothetically, I'm making that up, they could buy a bond that pays a 6 or a 6.5.
Correct.
Which is a better rate than 5.
Correct.
So then those 5s you're going to have to sell at a discount.
Less.
Correct.
Exactly. You sell at a discount because I can today at market pricing can buy a better interest rate bond.
Correct.
Okay.
Yes,
I understand.
Precisely.
Yes.
Yeah. And then just in terms of like $200 billion, I don't think anyone really knows this unless like you're, a fixed income expert. But I was like, how big is the MBS market, the mortgage-backed security market? I knew it was going to be big because
that's
trillions, right? But it's a $9 to $10 trillion market. Because
is that per year that they do?
Yeah.
Like outstanding. No, outstanding. Like how much?
The whole outstanding amount.
Correct. Yeah. Like how big is the market?
For all 30-year products down into the... Okay.
Yeah.
All right. That's
50 and under?
There's no 50 yet.
That's
50's
no
new.
50. We might as well talk about the 50-year mortgage.
Is that the one that Trump just said? You could take your mortgages out to 50 years, which is crazy.
Yeah, it's pretty crazy.
It's kind of crazy.
I feel like he's testing the feedback. Like that came out. He had
I'll take a 50-year loan.
He had the
I know, seriously.
He was talking about,
exactly. I like
transitory
it.
mortgages.
Keep payment down.
We're already doing interest only.
Yeah.
So.
But he was talking about transitory mortgages. I think he's just like I think he is a reactionary president in a good way, right? You want like a businessman is listening to the things coming in and making calls. And we saw this like earlier in this administration, we had Scott Bessent and Howard Lutnick kind of having this opposing reshoring job discussion that was happening, right? And as soon as sentiment went down and then Japan started selling off treasuries, we saw him kind of lean towards Bessent because they were talking about this hard stop with all the tariffs and all these things were going to be like, boom, we're just going to slam it. And they didn't. They backed off. And I think that that's kind of what's happening right now is like, we know that we're going into midterms and we have this really strong growing sentiment on affordability. And so this current administration is thinking, how do we make things more affordable? I think one thing that's good for the American economy, but they're not dumb. They want to get reelected. They need that strength running in. They need the momentum. And so we're seeing these test batches. What do the people think about this thought? What do we think about this? And I think that that's kind of what we're seeing right now. And I think they're throwing the whole kitchen sink at how do we bring interest rates down? I mean, we just bought a rental house. And what was really cool to watch is the amount of things it touches, right? Like the person selling the house, they had hired an attorney to get their trust ready to go. They had a realtor. I had a realtor. There's professional photographers there. We've got the lender. We've got the appraiser. We've got the home inspection.
Yeah, the home inspector.
Right now, the deal's closed. Now what's happening? I've got all the trades and plumbers, electricians, painters. And I feel like Trump knows this better than probably most people that are in the administration he's a real estate guy. We're real estate people.
Yep.
You know, real estate is such a powerhouse.
Yes.
And that's going to help. And I think it's working. So that's kind of I think this is what's happening. That's my take.
So then what do you think, just for fun, do you think the 50-year mortgage concept is going to be around, or is that just a fluke comment?
I'm not sure. I think it makes sense. I think that in practice, it didn't come off super popular. It was really kind of divisive, a lot of depending on what side of the aisle you're at,
depending on if you want to live debt free or if you want low payment.
Exactly. And
there's an affordability aspect
all
to that.
the rental guys that would be, I'd say, non-institutional guys that are buying rental homes would probably take them.
Yeah.
And I think just anytime you introduce more optionality or more consumer choice, it's a good thing. Like, I don't think it's good or bad, right?
Yeah.
I think that a 50-year
Gives
mortgage, because it's just another tool in the toolkit, right? And it all depends on what your overall outcome is. Like, say you bought your forever home and it's like, well, if we did a 30-year, if we did a 30-year, we qualify for this, but this home will let us qualify for a 50-year, and honey, I might get promoted in a couple of years, and we're not going to buy and sell that. We're not going to, because people always look like, well, if you carry that amortization schedule all the way out 50 years, like $1 million home, you're going to spend like $5 million total, like $4 million in interest. But some people are okay with that, right? Like, I don't think there's a right or a wrong. And also,
you get control of the asset. Your debt service
you're controlling
is low,
the asset,
but
you could always refi.
Well, you can always refi, but I do think that is like it would spike the market. So like now you're bringing all these new people and buyers in that have a new toolbox or a new set of tools.
Yes.
And so the home market would be driven up.
It would drive asset prices up for sure.
And so that's the tricky part of it. So now you're getting everyone pregnant with a 50-year mortgage.
I know. And I think but I just think it's so silly, right? Because we're the only nation that I know of that has the 30-year loan, right?
Okay. So we're already out there.
We're already out there, but no one's talking crap about a 30-year, and everyone does 30-year, right? Why don't you do a 15-year?
I'm sure 30-year was crazy when it came out.
But I feel like the people that were going out and talking crap about the 50-year have a 30-year loan. Like, unless it's like, why don't you do a 15-year, right? It's like everyone... Like when I bought my home, it's like, I look, hey, what does the 15-year do? That's a big payment. I'll take the 30.
Exactly. Now imagine what the 50 would give you. Oh, perfect. That one looks even better.
We're cash flow folks.
I think for most people, it's probably wise to try to pay down the debt on a house. And especially if you're borrowing 97%, right?
100%.
Like you're getting a VA loan or you're getting a normal FHA and you're borrowing 95% plus. Like if you're able to put down the 20%, like I think you can have a little bit more fun, maybe do like a 10-year interest only or something, but like that's more of a financial person versus somebody that's just wanting to buy their first time home.
Yeah.
If we keep rolling, we got the next part of this is
Jerome
Powell.
J Money.
The guy sitting on top of the Federal Reserve.
Yeah.
So Jerome Powell is being indicted under.
Sounds like threatening of indictment. It hasn't formally come down yet, right?
They got official
notice
that they're being investigated.
That they're being investigated for fraud, I think. And the main story is like misrepresentation on the cost of what they're doing at their new building. But it is pretty wild. Like I listened to another data set this morning, $700 million over budget.
On the taxpayer dime? Yeah.
It's annoying. So that's interesting. So like I think the comment was Trump can't get rid of him unless he has some legal, real reason to remove him. It has to be for like something that he really did wrong, and wrongdoing. And so I think Trump's just throwing grenades and for trying to figure it out. So where do you guys think that's going to go?
Okay. And just remind me, because I don't follow this stuff like you guys do. Jerome Powell is the head of the Federal Reserve.
And so that's our United States central bank.
Yes.
And
so
not technically a government entity.
What over budget on what?
They're building a new office.
Oh, headquarters.
But hold on. I just want to make this point. I feel like this whole thing is the same thing as saying we're going into Venezuela because they're trading drugs. Like that's not, that might be part of it, but I think it's much bigger. I think ultimately this whole thing that's happening with Jerome is to put pressure to lower rates, right? Like we're all, that's what's happening.
And that's the issue that the market has with this. You would think that came out Sunday night, right?
But the market's on a run.
Well, that
doesn't seem to have affected it.
Correct. That's what I mean. You would think that it would actually impact the Fed, like it would impact markets pretty dramatically, like with like the stock market, equity market selling off, and treasury yields, rising, because bonds would sell off. Because the whole thing is that Fed has independence, right? It's a non-governmental like agency. Yes, it is a government agency, but no, not really, because it's an independent agency that is filled with a bunch of economists that look at data and set interest rates, right? Mm-hmm. The Fed funds rate and all the other tools that they have. And so it needs to be independent of the government, let's call it the executive branch, right? Or Congress, because you don't want to have political influence on what to do about interest rates, impacting the Federal Reserve or interest, because it has so many broader implications that could be really impactful to the overall market and economy and to everyday people.
Federal Reserve's point is that they shouldn't be political.
Correct.
Trump's making the point that he already was,
political. Correct.
Like he did a few rate reductions going into the election to try to help Biden's,
Trump's view.
That's Trump's view.
Yes.
But he did do that.
Yeah, and Trump appointed him, right?
So this is one of the guys he thought would maybe align, and then he ended up being, from a Trump's perspective, a viper, and sort of being more aligned with the Democratic side. Okay. And so, going into the election, he reduced rates
to try to bolster.
Now, their argument was that they were doing it purely off of data, and the politics were never a consideration. And Trump saying, "No, that's not right. Sure. You guys are totally political."
I think a lot of people, I don't think it's just Trump. I would say that there's a lot of people that think that there is manipulation, a political manipulation within the Fed.
Sure, and I think that no one can be completely unbiased, right? I think it's difficult, but I think it's unprecedented what the political powers now that are putting pressure on the Fed, and like what that does to the overall independence of the Fed. Mm-hmm. And so it has
things. He's just doing things that no one's ever really done.
Yeah. Well, one thing that I thought was cool too, because I don't know this person personally, but when I worked at BlackRock, the chief fixed income officer, Rick Reeder, who's a brilliant guy. The news was that he went and spoke with Trump and Bessent and some other people because they want to interview him for the next Fed chair. Which would be pretty cool and pretty interesting. I've never known. I mean, BlackRock always leaned very left. Like Larry Fink is the CEO and board chair, one of the founders, and the chairman of the board. Very much is a left-leaning person. He's a Democrat, but the chief fixed income officer Rick Reeder, who is probably the highest paid guy at BlackRock besides like, Larry and others, manages the trillions of dollars of BlackRock's, of assets. The main talking head, kind of like the head honcho there. It'd be really interesting if Rick Reeder took that job. He's brilliant, and I would be totally supportive of that because he's very sharp data focused.
Would he align with Trump?
But Trump likes him. Trump used to invest with Rick Reeder in BlackRock back in the day. And so in some of the big BlackRock funds, like Trump was an investor. I always heard that early on before Trump was even a president, that he was a client of BlackRock's, specifically Rick Reeder's funds. And so they've been buddies. And Rick Reeder, when the COVID epidemic broke out, because I was still there, he moved to Miami. It was so funny. He like jumps on this call, and it's with thousands of people, and he like bleached his hair and is like kind of like funny, like going through this midlife crisis. But like, so I can kind of see how he probably hangs around that kind of Florida, Palm Beach crew. But I think that would be something that the market, if Rick Reeder or somebody like that, a really like highly respected person across both sides of the aisle, that's very smart and understands markets. If like somebody like that gets into the next Fed chair, like that would be amazing. Like I would love that news, and I think the market would respond very,
and we're going to get a new one in May.
Correct.
Or
might be sooner.
Trump's trying to turbocharge that.
And just to address a comment you made earlier, I feel like, because you're like, it's a little unprecedented that we aren't seeing huge market volatility because of this. I feel like the noise is deafening with all this political turmoil that's happening constantly. Like him and Jerome have been going back and forth, and like the market's tired of, like they don't care right now.
They're like, whatever. The calluses are built up.
For sure. Totally. It's a bunch of talk. It's clickbait in a way. But I watched a funny like episode on a financial channel, and it went through a clip element in the middle where it was like, he's not smart. He's really dumb. He's so dumb. And Trump's just like hammering. He said it like 50 times.
What did he call him? Too late Jerome or something like that?
Yeah. He's got these great little nicknames.
He brands people with certain things because he just hits it persistently. It's so funny.
Oh my God.
Ted Cruz will forever be Lying Ted to me, just because that was such a good moniker. I feel like I always think of that when I see Ted Cruz. Lying Ted.
Tampon Tim.
Is that what they call him?
Waltz.
Now he's really in pickle.
Oh man.
I mean, you can go on and on with these nicknames.
Oh my God.
Okay, so let's talk bigger picture. What is the effect?
What's the effect of this? That's why I wanted to boil that down. So does this whole Jerome Powell thing move the needle? Are we going to see the federal funds borrowing rate, which is what Jerome Powell and the Federal Reserve people have control of? Does that move the needle? Do you think it's going to do anything on interest rates
over the next 6 months or until May? I guess 5 months. I don't think so. I don't think
even this year. Like even if somebody like you just mentioned gets a new guy that gets in there, are interest rates going to move that much?
I think so. I think that some early inflation data is already coming out, and I do think that inflation is becoming tame, is getting under control. It's still running like hot compared to because 2% is our target rate. We've been above 2% for a while. But it seems like it's coming down, that like downward trajectory, right? And unemployment has kind of creeped up a little bit. But I do think that people are in the consensus that rates are going to go lower. And I do think that whoever gets elected under this administration, that once that happens, treasury yields, without even the Fed touching the Fed funds rate, are going to go down, just because people are going to be pricing that in, that the Fed is going to start to be on a more rapid rate cutting policy.
So then what he's referring to, this is an interesting point when you clicked with the bond thing. Mm-hmm. So then what happens is everyone jumps in to get bonds, different year terms at, let's just say the 10-year. Mm-hmm. At, what's the 10-year today?
Under 4.2, it's like 4.18, something like that.
So then they buy it at 4.18 because they think that the market sentiment is a bunch of people are going to buy in to 10-year treasuries, which then allows you to sell your 10-year treasury
for more
at a little bit of a premium.
If it goes down to 3.8.
If there's more bidders, basically look at it as if there's 10 bidders, it only gets driven to X. Yeah. But if there's 100, you can make money on it.
Yeah.
And then, this is like more like mathematician, but like fixed income math land. the more duration, meaning the more term you take out, time you take out too. So say instead of buying the 10-year treasury, if you think that it's going to happen, you buy the 30-year.
Yeah.
The price is going to go up exponentially higher than the 10-year because of the way that fixed income gets priced, even if the rate,
well, the swing's
Was it
bigger.
guaranteed?
the swing's bigger, and then even
On
if
the
the
bid.
but even if the percentage wise goes
guaranteed
down,
rate.
if you just look at like 4.18%, like if they go down in the same percentage wise on the actual yield, the price acts differently. And so what Blake's saying is that speculators or folks that would get ahead of this news, right, would buy that in, is because people are going to start buying this in, and it drives the price of those bonds higher, which is how they can make money, because no one's going to hold, no trader, no logical person really kind of hold that for 30 years or 10 years, but they can make speculative kind of short-term bets.
It's kind of like
price.
the quick flip on a home.
Yes.
It's a quick flip on this fixed
Correct.
income bond.
Yeah.
Oh,
Yeah.
and they use all sorts of tools to do it. And then I can't move through this without saying this is what broke First Republic Bank and Silicon Valley Bank.
Yes, good job.
They had 30-year bonds, treasuries that they had
From
put
COVID.
all their reserves into it.
Oh, yes, that's
and
right.
then the bond market collapsed. So they basically had paid 2 times what they're trading for.
Oh.
Because the interest
And-
rates went up.
And the way that
Yes.
they're regulated makes them mark them down on their side at current market price. So it like collapsed their financials. And
I got a question.
That was a good job. Yeah, that's exactly what happened.
yeah, it's a kind of a regulated issue too.
Yes.
So it was pretty
Because
stupid.
didn't they get forced to
it
do
was
that?
pretty stupid of
Yeah.
the Fed to hit them as hard as they did, though.
Yeah.
Because the Fed knew that.
Yeah.
I know.
You know, so that's one thing of the Fed. Like they went vertical on their rate increases, and that was really interesting. Like, why did they need to break a couple banks?
Right.
It's just odd.
I feel like, depending on who you ask, it seems like the Fed, though, doesn't have that many tricks up their sleeve. Like they only have so many ways they can move.
I think that the best way to explain that is they were late.
Yeah.
They should have started moving prices up gradually over time. And then it was like they woke up from a dream and were like, oh no, we're crashing. And they pulled like super hard straight up. And I mean, I'll never forget that because asset prices on our side, we were buying, we were selling, we were doing deals. Rates were going up faster and prices were going down faster than you could figure out how to adjust for it real time.
Yeah.
Well, then this is a great segue into talking about the next topic, which is just like, okay, real estate price, asset prices, real estate, the real estate market, multifamily, what's going on there? Because I mean, essentially everything that, we're going to start to talk about in terms of, Tad, I know you mentioned today that there's a lot of news coming out that nationwide home rents have come down pretty precipitously, like 1%, you said?
Yeah, I'll pull up the numbers real quick before I jump because I had a question. I'm just curious. I hold about 20% in bonds on my portfolio, right? And that it's been a balance. It's saved me when we've seen large dips because bond values go up. So is it fair to say if bond values are continuing to go up, that's kind of a sign that there's some expectation that we're going to see a correction within the market run?
Okay, because of the inverse relation.
Teach me.
Bond values, are you talking price or yields?
I'm talking about, we just did it's the bond values I had educate me. The bond values I had on my portfolio when we had the market drop, they went through the roof and it saved me. Like the amount that I lost in the markets was corrected in my bond portfolio.
Oh yeah, and that's good. That's how it should behave.
So I just want clarification. What bonds? So is it like a pool?
I have a mixture of a handful,
they
municipal.
Okay.
So you probably have municipal bonds, corporate bonds, maybe you have some treasuries, but the math all works the same. So when this is why you've heard like the 60-40 portfolio, like forever, right? 60% equity stocks, 40% bonds. The reason why you do that is because when stocks sell off, bonds do well. When bonds sell off, stocks do well, right?
Yep.
Did I say that correctly?
Yeah. So now the professional guidance is 20% gold.
I think that's really good.
I think what's 20% bonds, 60%
And
equities.
Okay, and then
all right. We're doing good
and
there then.
and so the reason
Instead
why
of a 40-60, I see. Yeah.
and the reason why this whole thing is broken down, where the 60-40 portfolio doesn't work anymore, and people talk a lot about it like it's broken, is because the correlation between stocks and bonds has become more so present, meaning that when stocks sell off, bonds are selling off at the same time. So that like bonds actually aren't doing their job in a portfolio of correctly hedging.
Which is why, for the record, this is why figuring out and like accurately projecting interest rates for the next 10 years
is impossible.
Is really
it's like
not a good game.
No.
It's pure speculation.
Yeah.
Because the bonds are not acting like they should.
Correct.
They should be like gold. You know, like risk on, you would have more in equity. And then as soon as you feel like, something's getting weird, maybe this is the start of a decline in the markets, everyone would transition to bonds and gold and other safe assets, safe harbor assets.
What you're talking about when you see in your actual portfolio is something that actually happened, because it's everything we talked about. 10-year treasuries were like at 4.5%, 4.7% even last year, right? And now they're sitting at 4.1. And so the yields are coming down, so your price is going up. And the 10-year treasury is just the one that we always talk about, because you could benchmark that across any fixed income security, and it will all be true because everything kind of gets priced off of the 10-year because that's the risk-free rate. And so that's why that happened with you, is that when that you saw your bond portfolio appreciate in value. Now, you said that when your stocks didn't do well, the bonds did well. That is good. That means that's how it's supposed to act.
I agree.
But there's been more correlation amongst bonds and stocks over the last.
Because everyone's I'd say momentarily going to gold.
Yeah.
Yeah, but hold on, that's a different conversation.
Yeah.
So just to keep on track,
no, it's not. It's technically what's sucking demand out of the treasuries.
So you think that there's
and the
more
bonds.
demand with gold, so it's
well, but that wasn't my
from
original question.
stocks?
I want to hit this on the head, and then we can talk about that.
Yeah.
But my question is, if we're seeing all this demand for bonds, is that a symptom that we might be seeing a correction in markets? Because markets are on a run right now.
It's actually reversed. So and I'm talking about like finance 101. Like when I was getting my finance degree, this is like what you learn, right? If you're seeing yields go down, that means that people are getting fearful of the market, and it's a flight to safety to fixed income securities, and you see stocks sell off. Now, what you've seen recently is the market has been doing very well. The S&P 500 was up 17-18% last year. Tech stocks are on a toward run.
7, everyone's running.
But how did bonds perform last year? Very well, right? Just like you said. So they both performed exceptionally well. That's just generally not how the behavior has been historically. Usually, it's like, okay, stocks are on a it's risk on. So most people are trading into equities and holding equities. They're selling off fixed income securities. So they kind of work in this kind of like seesaw.
Where are they going to safe harbor now instead of treasuries?
It's gold. Yeah, it's gold and like crypto and these other types of uncorrelated assets. And so the way you track from a mathematical standpoint, and I am the furthest thing from that, but like, I do know people that are smart, and you kind of learn this stuff. Is through what's called beta, right? So beta is just a statistical way of being able to track correlations, and the beta for fixed income has increased. So a beta of 1 essentially means that you're tracking, call it the S&P 500, perfectly. So when the S&P 500 goes up, this whatever you own of the stock or whatever that asset is should go up as well, roughly in the same percentage. Now, bonds had a low beta, but now as the beta for bonds has started to increase, and where you're seeing more correlation or less correlation is in things like gold and silver, which historically have always been a hedge, but they haven't been a great hedge. And it's very like when people say, "Oh yeah, I hold gold as a hedge," like in finance, like when people said that like 10, 15 years ago, they kind of laugh at you. They're like, gold isn't really a great financial tool or hedge, again, if you look historically, right?
Mm-hmm.
It just doesn't
when you only look 30 years.
Correct, right? But
that's like the data set for Wall Street is really based pretty short term. It only goes back to
not to gold. Yeah, gold goes back.
So that's where I'd say the short-sightedness happened, but then the disruption in the world, because the world used to hold bonds to way higher levels. So like that's what's happening right now, and it's irrelevant to your topic. But I agree, like the thought needed to be finished. But my point is, the global demand for bonds has been reduced.
Correct,
and that's due to uncertainty in geopolitical things happening.
No,
it's bigger. It's the dollar.
But that's geopolitics. What are we talking about?
But it's the confidence in the dollar.
That's what I'm referencing when I make that comment.
Let's just wrap this. Okay. Let's just wrap up this whole in a circle, in a bow. It is the ever increasing debt, our ability to pay back that debt, the confidence of us being able to pay back that debt. And I'm not just talking the U.S. You can look at any other country, and it's all the same story. And I think the United States is in the best position. It's this. It's this. Political pressure on the Fed. This is why I was saying, like, this is a big deal, even though the markets aren't acting like it. It's like, oh, does the Fed have independence, or is it just going to be Trump that's going to now have a very strong political influence, or any politician, over the U.S. dollar and the ability to print more money, and then we can use, very I would say, like, predatory tools against other countries, right? Like currency manipulation, being able to tighten and strengthen just based on, like, the fiscal policy, the political policy of a given administration. And so, like, all of this wrapped up together, if you think about everything we're talking about, that is why, to Blake's point, you're seeing less demand for fixed income securities, U.S. debt, is because of these concerns. It really all comes down to the debt at the end of the day. So
then Trump wants to do something. So he buys $200 billion worth of this fixed income bond.
To kickstart.
To try to light the fire.
Yep.
And that is what is also referred to as quantitative easing. Mm-hmm. They're just I think they're honestly rebranding quantitative easing.
Yeah.
They tend to do this when they're going to increase money supply in total, like in debt, and so it's going to be but okay, so then the end means you should be cautious of exactly what bonds you hold as a hedge. Because I'm sure some are better than others, or you want it to be liquid to where it's not based on, like, you don't hold a bond that can be driven in price. Like, we hold a pool of treasuries and more of a big old pool of them, so you don't have the price volatility.
Yeah.
Like, something like that is probably the better solution. So you get the interest rate, but you don't have the volatility on the price.
Honestly, and, like, I think if you're someone that's listening to this and you're, some people are fixed income people and that's all they own, and they make good money, but they have really good portfolio managers, like, financial advisors that guide them to do that. But I don't own any bonds. I would way rather own mobile home parks and look at that as my quasi fixed income security, because mobile home parks have a super low beta. I mean, no one's calculated it, but the correlation between how net operating income and just prices that we've seen through multiple cycles, not even just over our lifetime, but, like, they've been tracking this since the 60s and the 70s. Mobile home parks have continually seen net operating income increase. The default rate on outstanding loans, commercial loans for mobile home parks, is like 0.00001. Like,
we should do this on our own portfolio just to have.
It's like non-existent.
Well, we've never defaulted.
Exactly.
I know, but we should show the core. Like, we should show what the market's done, like all the volatility over the last 5 years or 15 years, and then show our track record of what NOIs have done.
And so when you just think about like that, like, it's like, okay, there's my ballast, right? Like, that's what usually people go to fixed income for, is like.
But if you're going to hold fixed income because you want cash and liquidity,
and you want income,
then you'd want to lean shorter term.
Yeah, I mean, yeah, I would think,
like, that's what Buffett's doing on, like, hundreds of billions, is he's holding shorter term duration, because then you don't have the pricing risk. You could hold them. In worst case, you just hold them for the 6 months and you buy more.
And the other thing is too, like, if you just think about, like, shorter interest rate securities, like fixed income, like, the other thing is, if you just hold it to maturity and you just want the yield, like, do you really care if the Fed cuts rates, right? Because obviously the price of your bond is going to go down, but you're going to hold it to maturity. You just want the yield.
Exactly.
And then when it matures, you get back your
$100,000
term
then.
Right? You're like, hey, I'm getting 5% today, or whatever it is, 4% today. The Fed cuts rates, right? But if you go sell that, it's going to be worth less than your $100,000, right? Maybe it's worth, $80,000, right? Because it's a excuse me. No, it'd be worth more. Worth more. I know, going back and forth in my brain this morning, it's like, but it'd be worth more. So it's better to, like, lock in. And actually, I was listening to Rick Reeder. That's why he's on the front end of the curve right now. And he's like, I really like the front end of the curve to the shorter end of the belly. Like, listen to his talk.
Then you don't have the risk.
Yeah, you don't have the risk. You have liquidity there, and you're getting really good current income, versus, like, trying to trade out further out. And it's like,
that's where the volatility on your pricing is.
Yes. Yeah. And exactly.
anything else that we want to hammer before we move to like what's that going to do to rental rates and stuff?
No, but I think that this is all kind of, two quick things. I think part of the reason why we're seeing this unusual activity within the bond markets is because part of the reason why the stock market's been driven so hard is we're seeing the Magnificent Seven, all this tech doing great.
Yeah.
But like a lot of regular industry isn't doing great right now. And so then on the bond market, that would make sense where it's like, routine investment categories aren't being successful right now. So let's put in bonds. But it looks a little rosier because we have NVIDIA and all of this AI money flushing into the system.
Yeah.
The only other thing I did want to touch on is, so was it Atlanta Fed chair? They released that GDP forecast of 5%.
Yeah, that's
pretty amazing. So
amazing. So
they think. Wait, say it again.
There was an economic report just released by the Atlanta Fed chair that was saying that they think that 2026 is going to see 5% GDP growth.
Oh, wow.
Which is huge.
Gotcha.
I mean, that is huge.
And
Huge.
what is it normally?
I think 2's a good.
2 to 3?
2 to 3.
Yeah.
2 to 3 is a a 3 is great.
5
historically.
is excellent.
Yep.
Yeah.
And then 5 would be like unbelievable.
Yeah. And so the only, there's a great podcast. It's the All In podcast with Howard Lutnick. It just came out not too long ago. And Howard Lutnick talks about how he's forecasting and believes that GDP is going to be 6% this year. So then for the Atlanta Fed to say 5%, that's kind of when, after I told you, I came back over the holidays and doing, reading and diving into some podcasts and stuff, catching up on stuff. That's why when I came back and I chatted with Ted, I'm like, I don't know, I'm pretty bullish on 2026 because a 5 to 6% GDP print, and that's an annualized number. If we produce
everybody's starting to make more money.
Oh my goodness. That means the economy is humming. The only other time that there was a 6% GDP print was from China.
Oh,
no,
okay.
it was from China. And, that's all manipulation through the government and forcing manufacturing.
You mean China's GDP was running that
hot
growth?
I think Trump had a quarter that was 4.6 in his first term.
Probably.
Something like that. That's what my brain's saying. We'll see. I don't know.
I wouldn't.
Well, it does seem like the tea leaves right now for 2026 seem like risk is on, baby, and people are going to keep going.
I agree.
And markets are going to keep ripping. And if rates come down, maybe people can go buy homes and get settled in. And
so let's pose the next question, right?
Yeah.
Economy's waking up. People are starting to feel a little bit better about it. We're seeing the market doing well. We've got a lot of investors who are listening to the news. I was talking about this earlier today. I keep hearing, well, hey, national rent's dropping. So, we're real estate syndicators. We specialize in manufactured housing. So if I'm an investor coming to you, Ben, and saying, hey, I see your new deal, but your deal's forecasting rent growth over the next 10 years, every news channel is telling me that rents nationwide are dropping. Mm-hmm. How does that affect this asset? What is your response to those people?
Yeah, so Blake talks about this a lot. It's really a difference. Question. Yeah, it's a great question. And so it's two things. It's one, it's if I'm forecasting rent growth, it's because one, we have embedded rent growth. And what do I mean when I say embedded rent growth means that the rents that of the property that we're currently acquiring are below that of current market rent of our portfolio today or other competitors that are 95% occupied and collecting rents today. So we have embedded rent growth. And so on most all of our properties, actually every single one just about that we've been acquiring, we're usually seeing a 20 on the lower end to a 30% plus of embedded rent growth, meaning that the rents are at, let's just say $500 and they really should be at $750 or something like that, right? Which would actually be like 50%, but let's just say for example,
clean math.
So that's the first thing that I would look at, and then the way, if we want to bring it into the fixed income world, it's I look at that current yield. It's called an in-place cap rate. And let's say that in-place cap rate with those current market rents, the yield that we're paying today to buy that asset is 4.5%. I don't get as concerned about that. I look at what's called the mark-to-market cap rate. So I kind of gross up rents to today's market rent, assume the same occupancy. Maybe I'll gross it up, say, hey, we'll infill a couple more spaces and, it's a little bit higher. What's that mark-to-market cap rate? And if I'm at a 4.5%, then I go to a 7%. What is the current exit cap? Meaning like what's your terminal like cap rate, or like what's the going rate for a bond?
Well, if we took it out to market, what would it sell for?
Yeah,
on a
like,
cap rate.
And like, let's say that's 5. So that means that I just went, so if my exit cap or my term, my going cap rate, right, as Blake mentioned, is a 5. And I know that in year 3, all I got to do is gross up rents to get to current market rent, and I'm at a 7. I've just created a tremendous amount of value over the first 3 years. Now, when you get to year 3, you're at today's market rent. Now then you can make the assumption that you're going to see normal market rent growth, which is roughly 3%, right? And so that is, I guess, quote unquote speculation, but it's a good measured guess, right? To say, okay, we're going to gross up on a discounted cash flow 3% from years 3 to 10. And so now to your point, I just wanted to make that clear. To your point on what's happening nationwide, mostly in multifamily, is that Blake talks about how we're the tortoise and they're the hare. The reason why there's so much of this embedded rent growth is because during the last cycle, let's call it 2019 to 2021 too, there was incredible rent growth, 20+% nationwide, right? I mean, you had years where in certain like Sunbelt markets where it was like up 30%. And so apartments just went on a run. And anytime this happens, builders, the construction pipeline are like, wow, look at these rents that we could forecast when they're doing on their pro forma, what they can build to and what they can then get the rents at and then sell at.
And
right?
they had really cheap construction loan.
Exactly.
Interest,
they start putting shovels in the ground and they start increasing new supply. So the reason why rents were running up so much is because the COVID really gave everyone a sense of, hey, I could work from anywhere. I have a roommate now. I'm going to go get a new spot down in San Diego. I'm leaving San Francisco. I'm going to go down to San Diego, work at my tech job remotely, and I need an extra bedroom because that's going to be my office, right? And so that's kind of what you saw. You saw this supply all get absorbed, drove prices up. People put shovels in the ground. Interest rates started to creep up pretty high, very fast, as Blake talked about. All this supply, you can't stop. You have to finish. They finished. All this new supply came online. That demand kind of went away. All this new supply came online. And then you have to absorb all that inventory. How do you absorb the inventory? And what I mean by absorb, I just mean people moving into beds, right? Well, you have to do it through concessions and dropping rents, right? Because you need to get that building filled up so you can get out of that construction loan, put on permanent financing, and that developer can then sell it to an institution or whoever else, an owner of that's going to go and then manage that asset into the long term.
All I can say is thank God we weren't under the gun and had a bunch of new projects being built with variable rate construction loans. Those guys got put on the front burner and it got hot.
Yeah.
And so a lot of those guys building, I just feel for, because like the amount of rate growth that they increased the Fed borrowing rate, how fast they did was unprecedented. It's never been done. And so everyone had these floating rate loans, which are typically only 2 to 3 years. So it's not like you normally it's not that risky, and you build in a factor of maybe it goes up a couple percentage points over the whole 36 months. When that went up 4 or 5%, like it chewed through all the profits to where, a lot of banks are ending up with a brand new construction because the cost, when you factor in all that additional interest, it blew the budget, and they can't lease up and even refinance out of that construction loan. So then why rents are dipping right now? This is a tough moment in the leasing cycle. It's winter.
Yep.
Yes.
People kind of tend to make all those decisions and plan through winter, and then spring again, it'll be more of a lease up. Nationwide, I'd say that's pretty common. And then you got the later end of that supply coming online now. So like probably the next year, maybe next 2 years, this year, 26, 27, maybe there's a couple more, 1,000 units in these markets that comes online.
Yeah.
Well, so it's like, it's a stay alive moment in multi, and stay alive and everyone's trying to hold rate.
Yep.
So like I saw in Dallas, they're doing 8 weeks, and they're showing you how much it is per week, like how much rents are per bedroom.
Yeah.
So they're trying all these new marketing tactics to get people in, because there is people kind of when there is a downturn in economic news or people are having trouble with jobs, you'll have these younger couples or multi-generational families move into 3 bedrooms so they can all split the rent.
Exactly.
So there's a lot of competition on multifamily right now. And we just got a current on an apartment asset we manage. We got a current broker opinion of value. And we're going into a refinance this year. Mm-hmm. And it's a tough moment in multi. I wouldn't want to sell a multifamily asset right now, like a bigger multifamily asset that's not niche and like, and it's really getting impacted by that lease up right now. Like 90% in San Diego is like good. Like you're on top of your game if you're 90% occupied. I got confirmation of that. And then I'd say the 2-month free rent is a lot. So I got guidance to do like 4 to 6 weeks max. And that's pretty much what people are needing to do in order to stay above 90. But then rent growth is non-existent. And so if like, it's hard to say like how many years are you gonna have to hold rate, or do you have to tease rate? Well, instead of dropping the rental rate, what most people do is they give you a month or 2 free
concession
and hold the rate,
because then the rent roll after that 2 months burns off, you have the income and the NOI for the building is at that higher level. Yeah. And then if you need to size a loan off of that net operating income, you have it. And that's where the people are in a pickle on the new build stuff, because they need to get the occupancy up as fast as possible so that they can size a new permanent loan off of it and take out their construction loan. And construction loans are typically like 80% of cost. So it's a big number to get out from underneath. Yeah. Yeah. So then I think we're going to see a little bit of, in those really competitive markets where they got a lot of new inventory in multifamily, Phoenix, Vegas, Dallas, maybe Charlotte, some of those other markets, Florida, Miami, you're going to have a hard time infilling because everyone's racing against each other.
So there's a lot of supply. Yeah.
Whereas the dynamic of multifamily in this case, in apartments, you have a lot of competition. Everyone's really sharp on their management workflows versus like if you own single family homes right now, you're doing way better.
No, for sure.
Single family homes are way more sticky. People don't move between single family homes because it's harder to find good single family home rentals if you like where you're at.
Yeah.
You're going to think hard before you jump. So even if you get a couple $100 rent increase in a single family home, do you want to move to an apartment? Probably not. So then you want to go find a home in the area you like. That's harder to do.
Yeah, it is.
So, and from a sales perspective, if you go vacant right now, you can sell that home for a really fair number, if not a great number. So it's a good time in single family rentals.
Yeah.
I think we can all agree that the vast majority of this rent drop we're seeing is directly from multi. Like it's probably the primary 90% of it that's happening.
Yes.
And I think you hit on an interesting thing. There are segments of the consumer that are different by asset type, right? Like if you spend all of your life in a single family residential home, you're probably going to avoid moving to a apartment complex. I think it's the same thing for our consumer in manufactured housing. A lot of our customers have lived in a mobile home or have family who have lived in a mobile home for most of their lives. Even a lot of the people that work within the company have grown up and lived in mobile home parks. And I think that that's a little bit of insulation when we see these types of market trends where we have our specific demographic and consumer that is coming back and back again and filling in. And the other thing that I think is important to note too that's strong about our portfolio is specifically that we are in very hot markets. This amount of free or available inventory is going to soak up very quickly in places like Dallas, Fort Worth, Phoenix. It's not going to have that long of a run because it's consolidated already.
And I think that you're seeing strong population migration there, job growth, all of those things, and so people are moving there. I agree with you, and you bring up such a good point. And I know it's so interesting when you get into like almost the social like demographics of the tenant bases and you start thinking about that, because I agree with you completely. It's just a different consumer. The folks, one, they own their home, so that the stickiness of that is kind of
much better.
So much better. But yeah, I mean, when you think about who lives in an apartment and then who lives in a manufactured housing community, you don't really like have like young professionals or like folks that are like, kind of living in a manufactured housing community. You have more like families, people that have stuff, that need to store stuff, that want a yard, they want the space, they don't want to share an HVAC with somebody else. They have a few cars. Yeah, a few cars.
They're working on some stuff.
Yeah, exactly.
They have a little yard. They have chihuahuas.
Exactly. Exactly. So you don't
Everyone's
really,
got chihuahuas.
and so you don't like see them like necessarily like, oh, I'm going to move into an apartment. Right. And so, and the more that I've spent to like, on this asset class, the more that I've really have kind of like my eyes have opened of what makes it so special and like, how does it make it so defensive? And like, what is the number one thing that sets it apart? It comes down to the inability to build more. And it goes back to your same point on the single family homes, why those are holding up better. It's the same things I was talking about, like a different renter profile, but we're not building enough single family homes. Like we built a lot of apartments. There's a lot of competition there. We're really good at building apartments, right? But you cannot build more mobile home parks. I'm not saying you cannot, but it's just almost impossible because the NIMBYism, not my backyard, municipalities, cities.
You can't in Phoenix, you can't in Dallas.
Well, and so
that's really like, if you really boil it down, like what makes it so special? It's like the fixed supply dynamic.
And the fact that we've now gone from like 60s and 70s, maybe 80s, when the main portion of them came online and were built and developed. Well, now it's been 40, 50 years and they're in town.
I know.
So even if you were to say, okay, because I actually think like in the end, we can solve affordable housing if you let us build more manufactured housing communities around the world, 100%. Around the country, in core markets, but on the outskirts. Yeah. And they don't even have to be land lease communities. They could be for sale.
That's correct.
You could do it. And so like Steve, I actually love Steve Eisman for this. I listened to his stuff in the market recap. He says, no matter what you do, even like Trump trying to beat the drum on 50-year mortgage or reduce rates or this or that, the price of homes are just going to go up.
Correct.
And so we need to bring small, affordable homes back.
Yep.
And that should be like a big push. And so like in the end, we're trying to figure out long-term how to develop communities that are this, like even double wides are 1,200 square foot, 1,400 square foot. That's a perfect starter home.
Great homes.
Great
for people
island kitchens, 3-bedroom, 2-bath, beautiful. You can set them and make them look like stick built. But you're still in them for like $200K.
Yeah.
No matter where you go in the country.
Yep.
And so that would be our suggestion. So if you work for a city, let us know. We'll happily come out and look at building parks. Just give us the zoning.
Exactly.
It's a local issue. Like it's not a huge federal issue. It's a local issue.
Mm-hmm.
Yeah.
If they would let us run, we could do it. And even our mobile home parks that are in Phoenix, in Dallas, those are still going to be worth a lot of money because they're so close to the home.
Exactly. It's already developed out, right? There's no space. The land is finite being that close into the city. So you build outwards, just how cities have grown forever.
Another use case is like growing up, she lived in a nice newer Class A building, like when you were 20 something, 22.
Yeah.
And I lived in a little dinky like boutique apartment and downtown La Mesa. And I had a good run. And then my first apartment was $795, 1 bedroom. And then I moved to a little 2-bedroom and it was $1,200. And I was like, I'm stealing this thing. This thing is so cool. Little mom pop operator.
Yep.
And then they gave me a $250 rent increase. And I had been there for a while. I was kind of ready to start jumping. So I'm like, all right, that's good. I had another few months left and I looked around. Well, I went to a brand new Class A. And what I think is a hidden thing within the brand new stuff is they're so sharp at operations that they drive the rent up on you. The all-in rent is so much more than the teaser. So I went in, I paid the couple $100 to get my credit run, and me and my at the time fiance were going to move into a apartment, brand new. It was beautiful. The units were 9-foot, 10-foot ceilings. It was really nice. When you added up the base rent, it was like $1,800 plus a garage. Oh, you want a garage? That's another $150. Oh, you want this? You want that? Like every little thing. Yeah. I was all in for like $2,250, $2,300. Started base rate at like $1,799, and it was like I went home. I was like on the list. I was going to get a call. We were going to be able to select a couple units. I went home. I slept on it. I'm like, I can find a better deal on a rental home, and then I have my own place, and I can have a car, like an area to have an extra car and a yard and my dog And so I found a rental home that was older but cute for like $2,300. Even though I was going to pay a little bit more, I had a house.
Yep.
And so I think that's where the multifamily has gotten so good at squeezing every drop of income out of that asset class that it makes it a little bit unattractive if you start looking around. And you look at a mobile home park and a nice mobile home park that's nice and held up to a nice standard. you at like 50 to 75% of the cost of that multifamily asset, even a lesser quality, Class A is probably way out, probably like 50% of Class A. And then you look at a single family rental. Well, there's a disparity there, and you get 80% of what you get with a single family rental in a mobile home park, and you build equity.
Yep.
Well, also something to note, I went to both of those places that you lived. I've seen them. That was an older home. That was a 1950s build home off Allison. And our consumer, for the same price, because you're either in Class A, right, brand new, beautiful, or for the same price, you're in a 1950s house. Our consumer's in brand new house.
That's a great point.
For the same price, right? That is the benefit, because these houses coming out from Clayton are beautiful. We're talking $55,000, $60,000 house plus install and any markup. I mean, you're in it for under $100K. Your mortgage and your space rent matches local multifamily, and it's brand spanking new.
And to even further argue that point, you're in a community with the amenity package that is similar to an apartment complex that you would like to have and use that you wouldn't otherwise get by renting the 1950s house in a normal neighborhood around town. So it makes it even that much better. And you get that sense of community and the common area space and all that stuff that comes with it for the lower cost point.
Yep.
Totally. And you get Jennifer making every home and clubhouse like super cool.
So what's happening right now? What's hot, Jennifer?
Well, I think we all like hit on it in different like points through this. Like we get the opportunity to go in and create a nicer front entrance and nicer common area space to drive that value, to bring that. So as we put in new homes or even sell off older inventory, they're buying into a community that truly is a community. They can host birthday parties and, holiday events with their family and enjoy it. Whereas if you go rent a house or buy a home for less, you don't have that. So, and in an apartment community, you're only going to have a balcony. We just hit on that like a bunch. And so it's really kind of cool because you get a nice new home or a used home that's good with a yard and a dog and an area for your kids to ride a bike.
No, we will not. Well, okay,
it's going to be a pit bull.
No, it's not.
Sorry, denied.
I'm sorry. I'm just cracking jokes.
I love it.
Keep going.
And so, on the ops side, you and I and our team work a lot on some of these things, and you lead the charge on that. So what's a project right now that like is a good example for our investors that we're currently, implementing that's showing what we really bring as far as value for our consumer?
Well, we've got a lot actually, but one that stands out off the top of my head is one that has, when we first, it's a property that's got great bones. Like the bones are so good, but it was mismanaged for like years. And it's really kind of sad because the potential of these communities is just like so good if you actually just give it a little bit of attention. I mean, it's
they're
like
block buildings in Arizona.
Yes.
Like you need to make sure the roof is good, but then paint it, make it look nice.
And it's as simple as like the street lights. Like when you drive in at night, like how hard is it to just make the lights work? So when people drive home after they're getting off of work or picking their kids from after school programs and getting into your home, it's not pitch black dark. Yeah. Like, and it can be dark in certain times.
Well, these are big neighborhoods, they're mobile home parks, but you like big roads and spread out. So you need light, you need fresh paint, green grass, like
roads without potholes, like
signage.
It's simple and it's really not hard. And so yeah, we just have fun looking at it. And in addition to just maintaining the property good, we can then further improve the existing improvements that are there that just like make it full circle, like good for the investors and bring value to the residents that are going to drive resident retention and bring in new, make an incentive for new homeowners when we acquire these properties and there's vacancy and we're trying to fill and bring the occupancy up. Why would somebody move there instead of the next door brand new multi or a rental home in the area to bring that value to the mobile home park? So I feel like there's a lot. We do it very well. We're continuing to get better here.
Why don't you walk us through this project we're doing at Villa Cielo? this is a new one for our investors that we recently bought, and we're going through an overhaul. That's a pretty neat project. So
part of the Villa Trio portfolio.
Yeah.
That's a good one. And that was the one that actually came to mind. So this one in particular, it's got a front entry that looks messy right now. So let me just paint the picture of like what it is. We acquired a 100, how many is that one?
160?
I've lost track. 160 units, good 3 or 4 roads. It looks messy right now as you drive in, but you can tell that the bones are great. And there's no clubhouse here, but there is a fantastic playground area and a picnic spot where you could really create like an outdoor, grass area for kids to kick a soccer ball around, and a playground structure for the little ones to play. Clean
has
up.
nice old trees too, so you can kind of celebrate,
Yes.
trim them up and use them.
Especially in the front, a lot of shade in the hot summer days. And then it's got a great area in the back for like overflow parking for people who have more than like 2 cars, which happens a lot.
But we did that.
Yeah,
that was like
weird
parking.
dumpsters and homeless people back there.
It
when we got
it was a
so
homeless
odd.
encampment and like trash everywhere, and it was like very mismanaged.
And so shout out to the Zales. We did a job with Republic Service, renegotiated, got rid of the dumpsters, brought in individual trash cans to open up that area to become a parking location.
Like at some point we bring a lot of cleanliness and order, because like if you have a third car and they leave it out in front of the home, it's a fire risk, because fire trucks need to be able to come through if a home catches on fire, and like just safety. And then it brings like a nice, clean, orderly, set up for the community to thrive. And you can put a third car or a kid's car back there, and they can pay $25 a month and they can have access to extra parking.
Yeah.
Or they can have a boat or whatever. They can put it in the storage.
Totally. Yeah.
So versus just stuff everywhere. And I think that's one of the things you get with Comfort Capital and Comfort Communities is our crew. We're a family company, and you're going to get Jen in there with a mama bear heartfelt touch. and I mean,
do approach it that way. It's
real. Like you are like a huge heartfelt touch, and you run with a person that's going to overlay just pure beauty.
Well, and I'm excited. There. Like next week, we're going out again to look at some properties. And, every time I go on to a property, I ask myself, what more can we do here to make it even better than it already is? Or when you're starting from scratch, it's like, okay, let's make a laundry list of all of these things that we could do to uplift the community, to make it a nice, safe, clean place for somebody to live and enjoy being there, right? We don't want it to be a home. We want it to be a home that they're proud of, that they like can make lasting memories and like have things with their family and friends and celebrate that. So that's kind of how I approach it from a mental kind of perspective.
Yeah, like
so
having
cool.
pride of, it's so cool. Like having the pride of ownership too for the tenants. And then I think the difference between like us, to Blake's point versus other folks is that like we're true owner operators.
Yes.
And like
we're not an institution.
And we're not like flipping these things, you know what I mean? Like when you
long-term hold.
Yeah, when you're gonna buy something and you're gonna say, I'm gonna own this for a long time, you treat the asset way differently than if you're just like, hey, I'm in here for 3 years and I gotta keep costs super low because I'm gonna flip this thing and my margins are tight, and it's just completely different.
Well,
different
and you
mindset.
can tell, right? Like when we're all shopping for homes and you see a home that's sold and then you're, that one's getting flipped.
Yeah.
And then you go to, there it comes back like 2 or 3 months later because the flipper just bought it. Like you go walk that house. Like if you were to go walk it before it sold to that flipper and then walk it after the flip, you can tell it's a flipper that did it.
Oh man,
I can.
Yes.
Where it's like, that's kind of like the vision. Like we buy a property and we know we're going to hold it for, maybe an average of 8, but 10 years, right?
When you own something for 10 years, you got to make sure you do things right or else it'll come back and bite you.
Yeah. You can't do something half-assed so then you're going to be redoing it or retouching it again in 2 to 3 years. So
we're not putting makeup on the pig.
No. And really bringing good quality common area space that people can actually use and beat up on a little bit to like make it last and enjoy it. That's why it's there. You're
And
living in this
that's
community.
one of our core, like the way we were raised. One of
Yeah.
our principles is like, you take care of your things, take care of your assets.
Yes, you respect what you have.
Shout
and you
out
take care of
to
it.
a friend, Keith. You take care of the golden geese.
That's right.
You know, you
Yeah.
got golden geese. You want to take care of them. You want to take care of the people in the communities. Another thing is mobile home parks have the best sense of community.
Totally. Yeah.
Well,
It's unreal.
Well, we had those photos back of like a desert. Was it Desertama? It was an asset in Mesa, and there's these old photos. We have them downstairs. And,
Oh,
and
it's humming.
and it's
Yeah.
humming, and it's like in the 50s, 60s, and all these people are hanging out at the pool. and
Play
it's like that-
shuffleboard.
Yeah, you want that community, right?
Yeah.
People like that are happy to be there, like are proud. It's no different than a normal stick-built neighborhood, right? When you're talking about it, it's
100%.
like when the city comes in and redoes the roads and then the lights. Like, how much happy are you when you drive home, or when people put up lights around their house and there's lighting? It's like it really gives it a really good feel, and you're like, you know, it's like almost does something to your biology, right? It makes you happier.
Yeah. And you know, when you send your kid out on that bike out the front door, go ride your bike. They're safe. They're fine. Marianne, 2 doors down, is going to see him and know that that's Joe from 2 doors down, you know? And it's like the kids play, and it just, the whole thing becomes more fun to be involved with when you know your neighbors, and it's a good, safe place for families and kids to just like be.
Correct.
And I think we all like that. Yeah.
Amen. Well,
So.
I think we did an awesome job. Love that
Onward and
you're-
upward, as Tide would say.
Yeah. And thanks for joining us for another episode of the Cash Flow Quest. We'll wrap it up there, and we wish you the best. Have a great week. Cheers.
Cheers, guys.